Welcome to the Deep Dive. You gave us the sources on Ventas Inc., that's ticker VTR, and today we're really cutting straight to the core of this company. It's a massive $45 billion stake in the real estate behind the longevity economy.
That's right. Ventas is betting big, really big on this silver tsunami phenomenon. The massive wave of aging baby boomers are a huge healthcare real estate investment trust, a REIT, and the scale of what they're doing is pretty breathtaking.
Yeah, and the demographic story, I mean, it seems incredibly strong, right? The decades of demand baked in, you'd think. But our job today, our mission, is to look past that simple narrative and really tackle the central conflict we found in the data. As of October 11, 2025, our reference date, Ventas shares were sitting at $67.69. That price definitely reflects a lot of investor confidence.
It does.
But what's the sort of harsher reality hiding inside that valuation model?
Well, the harsh truth is that the market seems way ahead of the actual financials right now. Analysts, they're super bullish, lots of buy ratings. But our educational discounted cash flow model, the DCF, it puts the intrinsic value of Ventas at only about $54.79 per share.
$54.79. Wow, compared to $67.69.
Exactly. The current price is trading at a huge 23% premium to that estimate, which basically means the market is demanding years, literally years, of near-perfect execution just for investors getting in now to, break even. That huge valuation gap, that's the main risk we need to unpack today.
Okay, that 23% premium really sets the stage. So over the next little while, we're going to walk through all 7 key areas from the analysis, starting with how the business is structured, management's track record, and then digging into the risks and that final valuation picture. But just before we dive into that first big section, a quick note. If you find this kind of deep dive helpful, please do like and subscribe to the Stock Analytics AI channel. Members who join for just €4.99 a month get priority access to our deep dives. We're actually planning to cover the entire S&P 500 over the coming months, so members get the fastest track there. Or, hey, if you just want a one-off deep dive on a stock you're interested in, just drop us a super article. Okay, let's get grounded in the basics. What exactly does Ventas own and operate? We call this section Chapter 1, Business Understanding.
Right. So Ventas, being a REIT, it has to be income-focused. They're legally required to pay out at least 90% of their taxable income as dividends. But what's really striking is their sheer size. They're in the S&P 500. They own something like 1,400 properties globally. And get this, they are the second largest owner of senior housing in the entire world.
Wow. Okay, and it's not just one type of property, right?
Yeah.
The sources broke down their income stream, the net operating income, or NOI, into 3 pretty distinct segments. Understanding this split seems crucial.
Absolutely crucial, because the NOI split really defines their risk profile today. So first up, the biggest piece by far is the senior housing operating portfolio, which everyone calls SHP. That makes up a huge 57% of their NOI. Now, this is the high risk, but also high reward part of the business.
How does that work? High risk, high reward.
Well, Ventas owns the actual properties over 850 communities, but they don't run them day to day. They hire third-party operators, big names like Atria and Sunrise. And unlike a normal lease where you just collect rent, Ventas actually participates directly in how well those properties perform. So if occupancy goes up, if rents increase, Ventas sees that upside almost immediately. But the flip side is, if things slow down, they feel the pain directly too.
Okay, so that 57% makes them almost like a growth stock tied to real estate operations, not just a stable landlord collecting rent. Much more volatile, potentially. What about the other parts?
Exactly. Then you have the more stable core, the Outpatient Medical and Research segment, or OM&R. That's 27% of NOI. This is mostly medical office buildings, life science centers, think labs and research facilities. These are typically leased out long-term to big hospital systems, universities, biotech companies, so much more predictable, stable revenue streams there.
Okay, stable. And the last piece.
And the final slice, the smallest and arguably the safest, is the triple net leased properties, often called NNN. That's just 15% of NOI. This is your classic landlord setup. Ventas owns the building, but the tenant pays for everything, taxes, insurance, maintenance, you name it. This provides Ventas with a really steady, almost bond-like cash flow.
Got it. So a big bet on the operational side with SHOP, balanced by more stable medical and NNN leases. And this whole strategy, it really leans into those huge industry tailwinds, right? The demographics.
Oh, completely. The so-called silver tsunami. The population aged 80 and over is expected to grow something like 5% every single year through 2030. That's just massive, unprecedented demand for senior housing and healthcare services.
And it's not just demand, it's colliding with a supply issue.
Precisely. At the same time you have this demand surge, New construction of senior housing has basically fallen off a cliff, hit historic lows. So you've got this huge demographic wave crashing into a really tight supply situation. That imbalance is a massive tailwind for companies like Ventas who already have the properties.
What gives them an edge over competitors trying to capture this?
Well, scale is a big one. Being so large gives them a lower cost of capital, which is a huge advantage in real estate. They also have deep relationships with over 40 different operating partners. But the really interesting differentiator, I think, is their tech asset, Ventas OI.
Ventas OI. This isn't just some off-the-shelf software, is it?
No, not at all. It's their own proprietary data analytics platform. Apparently, it crunches over 1 billion data points from across their huge portfolio. It helps them and their operators figure out optimal pricing, staffing levels, marketing, basically fine-tuning operations in a way smaller players just can't replicate. It's a significant technological moat.
Okay, so a clear strategy, leaning into demographics with a tech edge. Let's talk about the people making the decisions. Who's leading Ventas? This brings us to Chapter 2. Management evaluation.
Yeah, you really can't talk about Ventas without talking about the CEO, Deborah Cafaro. She's actually one of the longest-serving female CEOs in the S&P 500. She took the helm way back in 1999.
And wasn't the company in rough shape back then?
Oh, absolutely. The context is critical. She stepped in when Ventas was apparently near collapse. Market cap had shrunk to just $200 million because a major tenant had gone bankrupt. It was a crisis situation.
So she didn't just steady the ship, she rebuilt it.
Totally transformed it. And the numbers back that up. Since she took over in that crisis period around 2000, her leadership has delivered an incredible annualized total shareholder return, TSR, of over 18%. That's significantly better than the benchmarks. It really speaks volumes about her strategic capability.
And that history of success seems to be fueling their current strategy. The sources mentioned a 1-2-3 strategy focused on growth through acquisitions, M&A. They're targeting $2 billion in new investments just in 2025.
That's the plan. It shows they're not resting on their laurels. They're actively using their scale and market position to keep growing, consistent with big deals they've done in the past, like acquiring Wexford Science or a new senior investment group. They're clearly still in growth mode.
And management also signaled confidence recently with a dividend, right? After that cut during the pandemic.
Yes, that's a really important signal. They made a tough call, a prudent one financially, to cut the dividend pretty sharply back in mid-2020 from 79 cents down to $1.45 per share. But then, in early 2025, they announced a 7% increase, bringing it up to $1.48 per share. That's management putting their money where their mouth is, signaling strong confidence in the ongoing recovery, especially in that key SHLP segment.
Okay, strong leadership, proven track record, confidence signaling. But this leads us to something the sources call the ROIC paradox.
Yeah.
That historical 18% return is amazing, but the current return on invested capital, basically, how much profit they actually generate from their assets, is only 2.8%. That seems low.
It is low. And that's the paradox, the real tension here. That fantastic long-term TSR seems to have been driven more by, let's say, financial strategy, smart acquisitions bought at the right time, using leverage effectively, accretive deals, rather than purely by high organic profitability from the properties themselves.
So financial engineering more than operational excellence historically.
You could argue that played a big part. And now, with the stock price so high, reflecting all that past success and future hope, the pressure shifts entirely. The burden is now squarely on that SA SHOT segment, that 57% of their income, to deliver really strong, organic, same-store growth. Growth high enough to actually generate the kind of returns that justify this premium valuation multiple. It's a big ask.
That really sharpens the focus. Let's dig into those numbers. We're now at Chapter 3, financial analysis.
Okay, so starting with the top line, revenue growth has definitely picked up. It's been accelerating, actually. For the 12 months ending June 30, 2025, year-over-year revenue growth hit 12.5%, reaching about $5.3 billion. So you can see that recovery playing out in the revenue figures.
Right, but as you said, it's a REIT. So standard net income isn't the best measure because of all the non-cash depreciation on the properties. We need to look at funds from operations, FFO.
Exactly, and specifically, normalized FFO. That's key because it strips out unusual or one-time items, giving you a cleaner picture of the recurring cash flow from operations. So normalized FFO per share came in at $3.19 in 2024. And for 2025, management's guidance projects that to grow to a midpoint of $3.41. That $3.41 is probably the single most important profitability metric analysts are watching.
Okay, $3.41.50 FFO guidance. Now, what about financial stability? The balance sheet, you mentioned leverage earlier.
Yeah, this is where things get a bit more cautious. The balance sheet carries quite a bit of debt. The debt-to-equity ratio is up there at 1.11. That's not necessarily unusual for a REIT. They use leverage, but it's substantial.
And there were a couple of other flags in the numbers.
Two main points of caution, yes. First, the current ratio. This measures short-term liquidity. Can they cover their immediate bills? It's low, sitting at 0.68. That means their current liabilities are actually higher than their current liquid assets. Again, common for big REITs relying on credit lines, but it does make them very dependent on smooth functioning credit markets. If credit tightens, that could be an issue.
Okay, low current ratio. What was the second point?
The second one is the interest coverage ratio. This looks at how easily their operating earnings, their EBIT, cover their interest payments. And it's pretty weak, honestly. EBIT only covers interest expenses about 1.5 times.
Only 1.5. That feels like cutting it close.
It is quite tight. It basically means if their operating income were to drop by just a third, which isn't unthinkable given that volatile SHOP segment makes up so much income, they wouldn't comfortably cover their fixed interest payments from operations. It highlights the financial risk embedded in that SHOP-heavy strategy.
So high leverage, low liquidity, tight interest coverage. But despite all that, the dividend itself looks safe for now.
Yes, based on that FFO guidance, it does. The FFO payout ratio, the annual dividend, $1.92 divided by the expected FFO, $3.41, is around 56%. That's actually quite healthy. It means they're only paying out a little over half their operating cash flow as dividends, leaving plenty of cushion in cash for reinvestment or debt reduction. So the dividend itself seems sustainable at the current level, assuming FFO hits guidance.
Okay, but this brings us right back to that core conflict we started with, the valuation dilemma. Because those financial stability metrics look okay, maybe a bit stretched, but the valuation, it's just sky high.
It really is. The trailing price to earnings, the PE ratio, is around 158. I mean, just for context, the average PE for the REIT industry is closer to 78. Even their big rival, Welltower, trades around 98. Ventas is way, way above its peers.
158 PE. That's tech stock territory, not usually REIT territory.
Exactly. It just hammers home the point from our DCF model. The market isn't valuing Ventas based on its current earnings or its, slightly shaky financial stability metrics. It's purely a bet on the future. A bet on flawless execution, massive growth driven by those demographics coming through perfectly.
All right, so that's the financial picture. Let's see what the professional analysts think. Does Wall Street agree with this premium? This takes us to Chapter 4, market sentiment.
Well, on the surface, Wall Street seems largely bought into the story. The consensus rating is a moderate buy or leaning towards buy. Out of 22 analysts covering the stock, 17 are bullish.
And their price targets reflect that optimism.
They do. The average 12-month price target sits in a range of about $75 to $79. That implies, potential upside of 11% to 70% from the current $67.69 time price.
So what's driving that? Why do they see it going to, say, $75? Are they just focused on the SHOP recovery?
That seems to be the main driver, yes. The analyst reports we looked at are forecasting a really strong, sustained rebound in that SHOP segment. They're specifically calling for things like a 10% jump in same-store occupancy over the next year and a half, plus continued strong rent growth because of that tight supply situation we talked about. That operational recovery is really underpinning those bullish price targets.
Okay, but are there any counterpoints? Any signs of caution creeping in, even among the bulls?
There are some technical notes. Short interest, the percentage of shares bet on the price falling is actually quite low, somewhere between 2.56% and 4.02%, which is generally seen as positive.
Right.
But you are starting to see some neutral ratings emerge from major investment banks. And the reasoning isn't that the company is bad, it's that the stock price has run up so much. The argument is that the current high price might have already captured all the expected good news, shrinking the potential upside and, importantly, the margin of safety if anything goes wrong.
So the easy money might already have been made, is what they're saying.
That seems to be the sentiment behind those neutral calls. Technically, the stock is still above its long-term 200-day moving average, which is bullish, but it's hovering much closer to its shorter-term 50-day average. It suggests the upward momentum might be slowing.
This difference between the overall bullish consensus and these emerging neutral voices is interesting. It leads perfectly into looking at who actually owns the stock. Let's move to Chapter 5, ownership structure.
Right, and the ownership structure here is, quite striking. First off, it's overwhelmingly dominated by institutions. Over 99% of Ventas stock is held by big funds. Think Vanguard, BlackRock, State Street, the usual giants.
Over 99%. That's incredibly high concentration.
It is. And even within that, the top 25 institutional holders control something like 71% of the entire company. So you have very large, presumably very sophisticated long-term investors who are clearly making a massive collective bet on Ventas.
Okay, so the big money is definitely betting on the bull case. But what about the people who know the company best? The insiders, the executives, the directors.
And here's where it gets really interesting and maybe a bit concerning, because there's a stark divergence. While institutions are loading up, insiders, the actual management team and board members, hold only a tiny fraction of the company, just 0.35% of the shares.
0.35%. That seems negligible for the leadership team.
It's very low. But even more telling is their recent activity. Over the last 12 months, the data shows that insiders have been consistent net sellers of the stock. They've sold, on balance, over 610,000 shares more than they've bought.
Wow. Over 500,000 shares sold, net, by insiders.
Yeah. Now, insiders sell for lots of reasons, right? Diversification, tax planning, buying a house. You always hear the standard explanations. But when you see consistent, significant net selling from the people running the company, especially when the stock price is near highs and the valuation looks stretched, well, it suggests that they, the ones with the most intimate knowledge, don't necessarily view the current price as a screaming bargain. It definitely warrants some caution for outside investors relying solely on the public narrative.
That is a really powerful contrast. Big institutions are all in. Insiders are quietly cashing out some chips. Okay, let's pull all these threads together and look explicitly at the potential downsides. Time for Chapter 6, Risk Assessment. We can use a classic SWOT framework. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start internally with strengths and weaknesses. The strengths are pretty clear from our discussion. Definite market leadership and scale, those strong relationships with operators, the unique Ventas OIO data platform, and, proven experience management under Caforo.
Okay, clear strengths. What about the internal weaknesses?
The weaknesses are primarily financial, as we touched upon. First, the substantial debt load, that 1.11 debt-to-equity ratio, isn't trivial. Second, the weak interest coverage, only covering interest 1.5 times with operating earnings, leaves little room for error. And third, the sheer sensitivity of their income stream, 57% coming from that operationally sensitive SI shop seasonment, makes their overall results quite volatile compared to a pure NNN REIT.
Right, those financial metrics stand out.
Yeah.
Now let's look externally. What are the major threats facing Ventas?
There are a couple of big ones highlighted in the sources. First is regulatory risk. Healthcare is heavily regulated, and that's intensifying. You're seeing states implement things like Certificate of Public Need laws or even mini HSR acts, basically, more state-level hurdles and reviews for healthcare deals and expansions. Plus, a significant chunk of their tenants' revenue relies on government programs like Medicare and Medicaid. Any changes to reimbursement rates or rules could directly impact Ventas' tenants and ultimately Ventas itself.
Okay, regulatory hurdles. What else? You mentioned geopolitical.
Yeah, this one was a bit surprising, but makes sense. The 2025 U.S. tariffs that were mentioned, specifically on pharmaceuticals and potentially other goods, these pose a kind of double threat to Ventas. On one hand, they could pressure the profitability of their life science tenants in the OM&R segment if drug costs or research supply costs go up. On the other hand, tariffs on construction materials could directly increase the cost of building new facilities or renovating existing ones, squeezing the returns on their future growth projects.
That's a threat maybe not everyone considers for a REIT. So regulation and tariffs are key threats. But the external opportunities are still massive, right?
Absolutely. The opportunity side is dominated by that enormous multi-decade demographic tailwind, the aging population needing more healthcare and housing. And that's combined with the highly favorable supply situation because new construction has been so low. That supply-demand imbalance remains the core opportunity for Ventas to capitalize on.
Okay, great breakdown of the SWOT. Let's bring it all home. We're at Chapter 7, Conclusion. Can you synthesize the bull and bear cases one last time?
Sure. The bull case is pretty straightforward. You're investing in a clear market leader in healthcare real estate. It's run by a highly respected, proven management team. The company is perfectly positioned to benefit from one of the most powerful demographic trends of our time, the aging population. And crucially, its core operating business, the SHOP segment, is demonstrating a strong recovery right now.
Simple and powerful. Now, the bear case.
The bear case centers on the price you have to pay for that story. The company carries significant leverage and has somewhat weak financial stability metrics, like that low current ratio and tight interest coverage. This increases risk. But the biggest issue is the extremely demanding valuation, that PE of 158. It leaves virtually zero margin of safety. Any misstep in execution, any unexpected regulatory change, any negative impact from those geopolitical threats like tariffs, any of that could hit the stock hard because perfection is already priced in.
And let's put the numbers on that valuation again.
Right. The stock, as of our reference date, was trading at $67.69. Our educational DCF model estimates the intrinsic value at $54.79 per share. That means the stock is trading at a significant 23% premium to that estimated fair value.
So wrapping it all up, what's the final outlook for someone considering Ventas?
Look, Ventas is fundamentally a solid, high-quality company exposed to very powerful long-term secular trends. You could definitely see it as a core long-term holding in the healthcare real estate space. However, the current price is a major hurdle. Buying in at this 23% premium means you're essentially betting that Ventas will not only meet but probably exceed the market's already very optimistic growth expectations. Unless that happens, the potential for attractive near-term returns seems limited, simply because so much good news is already reflected in that high stock price.
That really captures the dilemma perfectly. A great company, undeniable tailwinds, but a potentially prohibitive price tag right now. So here's the final provocative thought we want to leave you with. We heard that Ventas's past success, that incredible 18% TSR, relied quite heavily on smart financial strategy and M&A, maybe more so than on high organic returns from its properties. Given that history, how confident are you, the listener, that the current recovery in the SA Shop P segment can generate enough organic profit growth, not just deal making, to truly justify paying that 23% premium valuation today? Something to chew on. Thank you so much for sharing your sources and digging into Ventas with us today. If you found this analysis valuable, please do hit that like button and subscribe to Stock Analytics AI. And don't forget, members get priority access for just $4.29 a month as we work through the entire S&P 500.
And just the standard but important reminder. This analysis was generated by an AI system. It's purely for educational and informational purposes. It absolutely should not be considered financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.